The college dropout who beat Wall Street. Picture this. You are 27 years old, sitting across from some of the most powerful executives on Wall Street, and you are telling them that their multi-billion-dollar company is about to collapse. They are laughing at you. The financial media is calling you crazy. Even your own investors are starting to doubt your judgment. But what if I told you that this exact moment, when everyone thought you were completely wrong, would make you $500 million richer and establish you as one of the most feared investors on Wall Street? What if I told you that this college dropout, who started with borrowed money in a tiny office, would become so accurate at predicting corporate disasters that CEOs would literally change their business strategies just to avoid his attention? This is not a story about luck or insider information. This is the true story of David Einhorn and how he used pure analytical thinking and unshakable conviction to beat Wall Street at its own game while everyone else was following the crowd. But here is what makes David's story different from every other Wall Street success story. He did not win by following the rules. He won by questioning everything that everyone else accepted as truth. He made his fortune not by buying what was popular, but by betting against what everyone else believed was certain. By the end of this story, you will understand exactly how a 27-year-old with no formal Wall Street training built a hedge fund worth billions by doing the opposite of what every expert recommended. You will learn the specific analytical framework he used to spot lies and manipulation that fooled even the most sophisticated investors. And you will discover why sometimes the most profitable strategy is being willing to stand completely alone against conventional wisdom. But most importantly, you will see how intellectual honesty and rigorous thinking can create extraordinary wealth, even when you are competing against people with decades more experience and billions more in resources. Let me take you back to where it all began in 1996, when a recent college graduate with a passion for poker and a hatred of corporate lies was about to revolutionize how people think about investing. David Einhorn did not grow up dreaming of beating Wall Street. He grew up in New Jersey, the son of middle-class parents who valued education and hard work, but had no connections to the world of high finance. His father was an executive at a small company. His mother worked in healthcare. They were comfortable, but certainly not wealthy. What set David apart from an early age was not money or connections. It was his obsession with finding the truth, even when that truth was uncomfortable or unpopular. In college at Cornell University, David discovered poker. But he did not just play poker for fun. He studied it like a science. He analyzed probability, calculated odds, and most importantly, learned to read people. He discovered that most players made decisions based on emotion, hope, or fear, rather than mathematical reality. This was David's first lesson in what would later make him hundreds of millions of dollars. Most people, even smart people, do not make decisions based on facts. They make decisions based on what they want to believe is true. David became so good at poker that he was making more money from games than most of his classmates would make at their first jobs after graduation. But more importantly, he was developing skills that would prove invaluable on Wall Street: the ability to calculate risk, manage emotions under pressure, and most crucially, recognize when other people were bluffing. After graduating from Cornell, David briefly considered going to law school. His parents encouraged a traditional professional path: become a lawyer, get a stable job, build a predictable career. But David was fascinated by something much less predictable: the stock market. He had been reading about investing since high school, devouring books by legendary investors like Warren Buffett and Benjamin Graham. But unlike most people who read these books and tried to copy their strategies, David was more interested in understanding their thinking process. He noticed that the greatest investors shared one crucial characteristic. They were willing to disagree with popular opinion when their analysis suggested the crowd was wrong. They made money not by following trends, but by identifying when trends were based on false assumptions. So in 1996, at age 27, David made a decision that seemed crazy to everyone who knew him. He decided to start his own investment fund. He had no Wall Street experience. He had no wealthy connections. He had no track record managing other people's money. What he had was $27,000 in savings, an analytical mind, and absolute confidence in his ability to spot lies and manipulation. David rented a tiny office, bought some basic furniture, and founded Greenlight Capital. The name came from his belief that investors should only buy stocks when they had a green light, meaning their analysis clearly indicated the investment was undervalued and likely to increase in price. His initial strategy was simple but revolutionary. Instead of trying to pick winning stocks like most fund managers, David would focus equal attention on finding companies that were overvalued and bet against them through short selling. Short selling is when you borrow shares of a company, sell them immediately, and then buy them back later at hopefully a lower price, keeping the difference as profit. It is essentially betting that a company's stock will go down instead of up. Most investors avoided short selling because it seemed unpatriotic, negative, or simply too risky. But David saw it as essential for finding the truth about companies that were lying to investors. His reasoning was brilliant. If you can make money when stocks go down as well as when they go up, you have twice as many opportunities to profit. More importantly, you have incentive to find companies that are hiding problems, manipulating their financial statements, or simply overvalued by the market. David's first major success came in 1999, during the height of the dot-com bubble, when he decided to bet against a company called Allied Capital. Allied Capital was a business development company that lent money to small and medium-sized businesses. On the surface, it looked like a solid, conservative investment. The company reported steady profits, paid regular dividends, and was recommended by numerous Wall Street analysts. But when David dug deeper into their financial statements, he found something disturbing. Many of their reported profits came from marking up the value of their investments based on optimistic assumptions rather than actual cash flow. In simple terms, Allied Capital was claiming their investments were worth more than they could actually sell them for, making their profits appear higher than they really were. It was not technically illegal, but it was misleading to investors who thought they were buying shares in a profitable company. David spent months analyzing Allied Capital's financial statements, reading SEC filings, and even investigating some of the companies that Allied had invested in. The more he learned, the more convinced he became that Allied Capital was significantly overvalued. So he began short-selling Allied Capital stock and publicly explaining why he believed the company was worth much less than its current stock price suggested. The reaction was swift and brutal. Allied Capital's executives accused David of spreading false information to manipulate their stock price. Financial journalists who had relationships with the company wrote articles questioning David's motives and competence. Even some of his own investors worried that he was taking on too much risk by publicly challenging a respected company. But David had learned something crucial from his poker days. When you have strong analytical evidence supporting your position, you do not fold just because other people are betting against you. You increase your bet. So instead of backing down, David doubled his position against Allied Capital. He gave detailed presentations explaining exactly why he believed the company was overvalued. He published research reports documenting his findings. He essentially went to war with a company that had significantly more resources and connections than his small hedge fund. For almost 2 years, it looked like David was wrong. Allied Capital's stock price remained relatively stable, while David's fund lost money on the short position every month. His investors began questioning his judgment. Financial media portrayed him as an inexperienced manager who had bitten off more than he could chew. But David understood something that most investors do not. Being right and making money are not always the same thing in the short term. Markets can stay irrational longer than individual investors can stay solvent. The key is having enough conviction and capital to wait for reality to catch up with your analysis. And eventually, reality did catch up. In 2001, Allied Capital began reporting lower profits and dividend cuts. Regulatory investigations revealed that many of David's concerns about their accounting practices were valid. The stock price began falling dramatically, and David's short position generated millions of dollars in profits for his fund. But more importantly, David had established something invaluable, a reputation for rigorous analysis and intellectual honesty. Investors began to pay attention to his research, not just because he made money, but because he was consistently right about companies that others had missed or ignored. This success with Allied Capital led to David's next major triumph, and the trade that would make him truly famous on Wall Street, his bet against Lehman Brothers. In 2007, Lehman Brothers was one of the most respected investment banks on Wall Street. The company had survived the Civil War, 2 world wars, and numerous financial crises over more than 150 years. It was considered a pillar of American finance, but David noticed something that concerned him. Lehman Brothers was taking enormous risks with borrowed money to invest in subprime mortgages and real estate at exactly the time when those markets appeared to be peaking. Subprime mortgages were loans made to people with poor credit histories who were unlikely to be able to repay them if housing prices stopped rising. Many of these loans required no down payment, no proof of income, and had interest rates that would increase dramatically after an initial period. David realized that if housing prices stopped rising or began falling, many of these borrowers would default on their loans, causing massive losses for companies like Lehman Brothers that had invested heavily in mortgage-related securities. But here is what made David's analysis brilliant. While everyone else was looking at Lehman's reported profits and assuming the company was financially healthy, David was looking at the underlying assets and concluding that many of them were worth far less than Lehman claimed. Lehman Brothers was using accounting techniques that allowed them to report profits on mortgage investments based on theoretical models rather than actual market prices. They were essentially claiming that assets were valuable because their computer models said they should be valuable, not because anyone was actually willing to pay those prices. David began building a massive short position against Lehman Brothers stock in early 2007. Once again, the reaction was overwhelmingly negative. Lehman's executives accused him of spreading rumors. Financial analysts called his concerns overblown. Many investors saw betting against such an established, prestigious company as almost unpatriotic. But David had learned to ignore the noise and focus on the numbers. His analysis suggested that Lehman Brothers had too much debt, too much exposure to a housing market that was clearly overvalued, and too little actual capital to survive a significant downturn in real estate prices. For over a year, David looked wrong again. Lehman Brothers continued reporting profits, their stock price remained high, and David's fund lost money every month on the short position. Financial media began portraying him as a one-hit wonder who had gotten lucky with allied capital, but was now making a costly mistake. Some of his investors began withdrawing money from the fund, convinced that David was too stubborn to admit when he was wrong. Industry conferences featured panels discussing whether David Einhorn had lost his analytical edge. But David understood something that most investors learn too late. Being early is not the same as being wrong. If your analysis is correct, being early just means you need more patience and conviction than the average investor possesses. And then, in 2008, the housing market collapsed. Subprime mortgages began defaulting at unprecedented rates. Real estate prices fell dramatically. Companies that had invested heavily in mortgage-related securities began reporting massive losses. Lehman Brothers, which had claimed for months that their mortgage investments were profitable and well managed, suddenly announced losses of billions of dollars. Their stock price began falling rapidly as investors realized that the company's actual financial condition was far worse than their reported numbers had suggested. In September 2008, Lehman Brothers filed for bankruptcy, the largest corporate bankruptcy in American history at that time. A company that had survived for over 150 years collapsed within a matter of days once investors lost confidence in their financial statements. David's short position against Lehman Brothers generated over $100 million in profits for his fund, but more importantly, it established him as one of the most prescient analysts on Wall Street. He had publicly predicted the collapse of a major financial institution months before it happened, while most experts were still recommending the stock. The financial media that had criticized David for years suddenly wanted to interview him constantly. Investment conferences competed to have him as a keynote speaker. Other hedge fund managers began copying his research methods and investment strategies. But David's success was not just about making money. It was about proving that rigorous, independent analysis could beat even the most sophisticated and well-connected Wall Street institutions. His success with Lehman Brothers led to even more profitable trades. He identified other companies that were hiding problems through creative accounting, over-leveraged business models, or simply overvalued by the market. He bet against companies like Green Mountain Coffee Roasters, which he believed was using accounting tricks to inflate their profits. He questioned the business model of companies like Herbalife, which he argued was essentially a pyramid scheme disguised as a legitimate business. In each case, David's approach was the same: exhaustive research, rigorous analysis, and the courage to take large positions when his evidence supported unpopular conclusions. By 2010, Greenlight Capital was managing over $8 billion in assets. David personally had earned hundreds of millions of dollars from his investment success. More importantly, He had established himself as one of the most respected and feared analysts on Wall Street. Companies began changing their business practices just to avoid becoming targets of David's research. CEOs would modify their accounting methods or business strategies if they thought David might identify them as overvalued or problematic. But David did not stop there. He understood that his real edge was not just analytical ability. It was the willingness to challenge powerful institutions and popular opinions when his research suggested they were wrong. He began writing detailed letters to shareholders of companies he was betting against, explaining exactly why he believed their stock was overvalued. These letters became famous on Wall Street for their clarity, thoroughness, and devastating effectiveness. When David published a research report questioning a company's accounting practices or business model, the stock price would often fall immediately just based on his reputation for being right about such things. But perhaps David's most impressive trade came in 2012, when he identified what he believed was the biggest corporate fraud in history, a nutritional supplement company called Herbalife. Herbalife claimed to be a legitimate direct-selling company that sold weight loss and nutrition products through independent distributors. But David's research suggested that it was actually a pyramid scheme that made most of its money by recruiting new distributors rather than selling products to actual consumers who were not part of the distribution network. David took a massive short position against Herbalife and gave a detailed presentation explaining why he believed the company was defrauding investors and distributors alike. He argued that the vast majority of Herbalife distributors lost money, and that the company's profits came primarily from selling overpriced products to their own distributors rather than to genuine retail customers. The reaction to David's Herbalife presentation was unlike anything Wall Street had seen before. Other hedge fund managers took sides, with some supporting David's analysis and others arguing that Herbalife was a legitimate business. The battle over Herbalife became a public spectacle that attracted attention from regulators, politicians, and financial media around the world. David found himself defending his research against billionaire investors who disagreed with his conclusions and had taken large positions, betting that Herbalife's stock would rise. The controversy lasted for years, with David's fund losing money on the Herbalife position while he waited for regulators and the market to recognize what he believed was obvious fraud. Eventually, in 2016, the Federal Trade Commission reached a settlement with Herbalife that required the company to fundamentally restructure its business model and pay $200 million in fines. While Herbalife was allowed to continue operating, the settlement validated many of David's concerns about the company's practices. David's position against Herbalife generated significant profits, but more importantly, it demonstrated his willingness to take on powerful opponents when he believed his analysis was correct, even when the battle lasted much longer than anyone expected. Today, David Einhorn manages over $1 billion at Greenlight Capital and has a personal net worth estimated at over $1 billion. He has become one of the most successful and respected hedge fund managers in history, known for his ability to identify overvalued companies and corporate fraud before other investors recognize the problems. But David's success is about more than just making money. He has fundamentally changed how Wall Street thinks about research and analysis. His approach, combining exhaustive fundamental analysis with the courage to take contrarian positions has influenced an entire generation of investors. More importantly, David has proven that intellectual honesty and rigorous thinking can create extraordinary wealth, even when competing against people with more experience, better connections, and significantly more resources. His success came not from following conventional wisdom or copying other successful investors, but from developing his own analytical framework and having the conviction to act on his conclusions, even when everyone else disagreed. So what can we learn from David Einhorn's incredible journey from college poker player to Wall Street legend? First, develop your own analytical framework and trust it more than popular opinion. David succeeded because he learned to think independently and question assumptions that everyone else accepted without investigation. Second, being right is more important than being early. Many of David's most profitable trades lost money for months or even years before his analysis proved correct. Success requires patience and conviction, not just intelligence. Third, rigorous research can overcome lack of experience and connections. David competed successfully against Wall Street veterans by working harder and thinking more clearly than his competitors, not by having better access to information or relationships. Fourth, embrace unpopular positions when your analysis supports them. David made his fortune by betting against companies that most people believed were successful and stable. The biggest opportunities often come from disagreeing with conventional wisdom. Finally, intellectual honesty is more profitable than wishful thinking. David succeeded because he was willing to acknowledge uncomfortable truths about companies and markets, even when those truths were unpopular or seemed counterintuitive. Today, when David Einhorn publishes research questioning a company's business model or accounting practices, CEOs and investors around the world pay attention. His analysis can move stock prices and influence corporate behavior across entire industries. And it all started with a college graduate who loved poker, hated lies, and was willing to bet everything on his ability to see through the deception that fooled everyone else. Your next great opportunity might require disagreeing with everyone around you and standing alone with your convictions. The question is, are you willing to trust your analysis more than popular opinion, even when the stakes are enormous?